Good morning, ladies and gentlemen, and boys and girls. I am Kenny Polcari, your host of the party, and today is August 16, 2022, and it's a big retailing day. But let's figure out what happened yesterday and what's going to happen today and what you need to know to get your day started. Well, stocks notched another good day yesterday, right? But this morning, they're churning right ahead of those Home Depot and Walmart earnings, which came out, which are all better than expected. So we'll get to that. Remember, Walmart slashed and burned their estimates 3 weeks ago. Oil and gold were lower, treasury yields were higher, the curve remains inverted. Walmart and Home Depot, like I said, are due out before the opening. They came out. There's going to be more tomorrow. The FOMC is also tomorrow. And many are asking, will they suggest a pivot? Which I say absolutely not. And what are we having for dinner? We're having the Pork Chips Benevento Style, but we'll talk about that in a moment. So stocks were lower yesterday morning in the pre-market, right? Setting up for what many thought just might be a small pullback or digestion after the surge high that we've seen over the last couple of weeks. But that was not going to be the way it turned out. While stocks did begin the day in the red, they rallied, came up to unchanged, sold off, and then rallied again, suddenly waking up at about 11:45 in the morning, and they rocketed higher, blasting up and through the unchanged line and ending the day up. The Dow adding 150 points, the S&P up 17, the NASDAQ up 80, the Russell's up 5. Only the transports ended the day lower, but not even significantly, losing just 50 points. Oil was down. Gold was down slightly. Treasury yields up, right? Which means prices were down. But they remain completely upside down and inverted going on now 8 weeks. Does that tell you anything? No, we'll talk about that. Overnight, we learned that China, right? They had reported disappointing macro data, industrial output, retail sales missing expectations, and that sent a message that the Chinese economy might be stalling. In addition, the People's Bank of China cut interest rates to try and stop the bleed in the real estate market. Whatever. I don't pay much attention to what goes on in China because I don't really believe much of what they say. But the oil traders took it all to heart, suggesting that if China is slowing down, the demand for oil will have to collapse. I mean, as oil goes, China goes, right? So is that the game that we're playing now? In any event, they sold oil off on the back of that news. They also sold oil off on the news that the Saudis have suddenly decided they can ramp up production if the government asks them to, right? This after they just cut their global demand estimate last week, yet they cut their estimate, yet they're willing to ramp up production. So again, it's conflicting and confusing. And did you see how much money Saudi Aramco made last quarter? I mean, gobs of money. And then at 8:30, we got a very weak Empire State Manufacturing report. Fell by 42 points versus the expected loss of 16 points. That gave fuel to the recession story. In any event, the trader types thought that maybe they should ring the cash register and take some profits after the recent surge higher in stock prices. So they did in the morning. And then the rumors started again that with such a weak manufacturing report, how could you even possibly think that the Fed could consider being aggressive in September? Why would they raise rates by 75 basis points when the data is suggesting a slowdown and the Treasury yield curve remains inverted for the 8th week? Suggesting that a recession is not only coming, but it's coming quickly. But you know me, I think it's already here, but that's a whole other story, and we could sit there and argue about it. I don't really want to argue about it. It is what it is. Everyone believes what they believe, and then they'll position themselves accordingly. So it's not a big deal. Let's not argue about it. And the algos went into overdrive. Right after that, they took stocks up, ending the day about 0.5% higher across the board. 9 of the 11 S&P sectors ended the day higher, with defensive sectors leading the way. Utilities and consumer staples, right, XLU and XLP, always considered boring, rose 0.8 and 1% respectively. But remember what I've been saying for 6 months now. Boring can be beautiful in an anxious environment. Utilities up 8% year to date, which is a win. Staples are off 1% year to date, which I guess is also a win considering the market's down 20%. Energy, as you might expect, got slammed on the China news and the Saudi news. The XLE lost 2% on the day, but is still leading the way for 2022, up 38% year to date. Financials and basic materials also ended a bit lower, less than 0.1%, while the rest of the group ended up about 0.4%, kind of across the board. Right, the other sectors. Retail names ended essentially flat. The XRT up less than 0.1% as we wait for a slew of retail earnings today and this week. This morning we're going to hear from Walmart and Home Depot, and like I said, we already did, and they beat. Now, that's an interesting contrast because one's a big consumer staples destination while the other's a consumer discretionary destination, right? I mean, you need food and clothing every day. Think Walmart. You don't need pipes and wallboard and lumber and cabinets and appliances every day. Think Home Depot. But both are very popular stocks and very popular destinations. I will say, I do like going to Home Depot, but I like going to the grocery store more just because I like food. Now remember, Walmart cut their estimates 3 weeks ago and offered up sobering guidance. And the stock got clobbered then, right? They took the pain then. And last week, they also announced additional layoffs. So it's going to be really difficult for them to miss the new lower estimate and announce anything much different than what they prepared us for. Really difficult. And in fact, they didn't. They beat the number by 13% or something. It's ridiculous. So I think the stock rallies in any event. I think it rallies. But I guess anything could happen, right? Remember, Walmart's down 8% year to date, but it was down 18% at the lows of May and June, right? It held tight at the $118 line. It has since rallied 12% off that low, leaving it kissing resistance at 132. If the report is what it is, all the negative news is priced in, I suspect that they will continue to try to buy it. Home Depot, on the other hand, is a different animal, right? But one that investors love, right? Home Depot is a well-owned stock, and they love it. It's a great stock. Stock is down 23% year to date, but it was down as much as 35% only 6 weeks ago. It's also rallied over the past 2 weeks and has taken back 17% of those major losses, leaving it above both the 50 and 100-day moving averages. It feels like it wants to go higher. I think it will, unless they surprise us with some negative news, which I do not think they will do. But in this environment, if they had negative news, they would have revealed it weeks ago, just like Walmart and Target did. It would be suicide for them not to have pre-announced if the data was negative, which leads me to surmise that they will provide at least a meet, if not a beat. And in fact, they beat. The focus, as usual, will be on the margins, on inventory, top and bottom line revenues, net sales, online sales, same-store sales, blah, blah, blah. You know the whole deal, right? What do they say about the consumer? All that stuff. Well, will we see them raise their dividend? Or will they announce a new buyback program, right? Remember, Walmart's expected to repurchase $10 billion worth of stock in 2023 on top of the $10 billion that they're buying in 22. The dividend yield is 1.7% in Walmart. Home Depot's in the middle of a $20 billion repurchase plan and has a 2.4% dividend yield. Just so you know, and dividend yields are good in an anxious environment because they pay you for owning the stock. The question now is, was the recent rally in both of these names, as well as the other names in the group, was it a buy the rumor, sell the news type of event? Could they report positive news and see traders sell these stocks to lock in those double-digit gains over the last 2 weeks? Sit tight, because we're going to find out it's about to get exciting. Later in the week, we're going to hear from Lowe's and Target and TJ Maxx and BJ's and Kohl's and Tapestry. I suspect the guidance will be the same, right? Caution ahead, floor slippery when wet. You know those signs. You see them all over the place, right? And it's so true because they are slippery. In any event, stocks have taken a real hit this year and many think the worst is over and that it's only up from here. I'm in the other camp right now. I think that the bottom is in 3,600 on the S&P back in June. I do think, though, that we could retest lower in the weeks ahead, maybe somewhere in the 38 to 4,000 range, which would represent a 6% to 11% move lower from here. And that's only because I don't think we've priced in the coming earnings revisions for the third and fourth quarter by analysts yet, right? Those are going to start in the next month or so. In addition, I also think the market is a little bit overconfident in thinking that JJ and the Fed are going to pivot and be less aggressive because I don't see that happening. At least I hope it doesn't happen because it sends the wrong message. But I think that's what the market's pricing in. Inflation is still running at 8.5% year over year. That's 4 times greater than their target of 2%. We've heard from multiple non-voting Fed members tell us that inflation is the number one concern. We've heard Jimmy Bullard, St. Louis Fed, who is a voting member, tell us that he's expecting Fed funds to be at 4 to 4.25 by year end. We're currently at 2.25, 2.5, so you do the math. Can the Fed pivot if that's the goal by December? Hardly. And so I just think the rally might be a little bit long in the tooth, which all that means is get ready for a little bit of chop ahead, right? Doesn't mean light your hair on fire, just means chop ahead. This morning, U.S. futures are churning as we await both the eco data and the earnings data, right? At 5 a.m., Dow futures are up 3, S&P's down 1, NASDAQ down 10, and the Russell is up 1 point. So not a whole lot going on, right? as we wait. Now, these earnings today kind of came out, so we'll see how the tone gets. Eco data today is all about housing. Housing starts expected to be down 2%. Building permits down 3.3%. 30-year mortgage rates now running at 5.6%, likely to go higher. Yesterday, the Home Builders Sentiment Index registered 49. The lowest reading since 2007 in the depth of the great financial crisis. Industrial production is supposed to be up 0.3. Capacity utilization up 80.2%. Remember, a number greater than 80 suggests building inflationary pressures, right? 80.2 is not a big deal, but it is north of 80, so you have to start to watch that. Tomorrow, it's all about the Fed and what the FOMC minutes will say, and what will we learn. In my opinion, nothing new. Inflation is going to be the focus. There are two things of interest. What will they do in September, 50 or 75 basis points? The other is, will we start to reduce the balance sheet by $90 billion a month starting in September? My guess is that we might find a passing reference in there because remember, we were supposed to have been doing it at $45 billion for June, July, and August, and then go to 90 in September. I'm not even sure we've been doing the 45. No one wants to talk about it. Oil, which traded lower yesterday, is holding the line right now this morning at 88.5. It's now below all three trend lines. Further weakness could see it trade down to 84-ish, levels that seen last February. We know the recent weakness is about China and the Saudis ramping up production, but the third argument is all about the recession that supposedly doesn't exist but continues to weigh on prices. China economics weakness once again spurring renewed concerns that a global recession is coming and that will destroy demand for energy. I'm not buying that argument. I'm just not. I mean, the U.S. is in the middle of a robust economic expansion, right? All you have to do is ask Joey or Brian Deese or Corinne Jean-Pierre, Nancy Pelosi, Chucky Schumer, or Jared Bernstein. It's robust, the expansion. And so expansion demands energy to thrive. No, because if we're in a recession, then, right, we're not going to get it. But we're not. We're in this robust expansion. European markets are slightly higher, up about 0.4%. Spain is the outlier, up more than 1%. Joey is expected to sign the Schumer Manchin tax and spend bill today. He's coming back from vacation early just to do it. And remember, remember this. Remember when Chucky told Joe Manchin that if he signed on to this bill, then Manchin would get what he wanted in energy demands? Yeah, how's that working? Remember I said it was very suspect because the progressive left wasn't chiming in. Well, the progressive left is suddenly chiming in, right? They are now telling, they're now waiting for Joey to sign the bill, and then guess what? They have no intention of supporting any increases in energy production that Manchin put forward. 0, 0, 0. So Manchin got taken out to the woodshed and got spanked. Without the support of all members of Congress, his proposal for new energy production goes nowhere. Capiche? So we got higher taxes, we got more regulation, we got more IRS agents to go after the working and middle class, and less energy to help make us energy independent. But that's okay because we're going to spend billions and billions. Don't worry about it. And just to be clear, the CBO, the Congressional Budget Office, told Congress that the IRS expects to rake in $20 billion from the under 400,000 demographic, the exact demographic that they told us was off limits. The CBO, a government agency, said that's where the IRS is coming up with $20 billion. The S&P ended the day at 42.97, up 17 points. I think the rally's a bit long in the tooth, like I said, but that doesn't mean it can't go higher. In any event, I think we're in for more chop in the weeks ahead. September and October tend to be volatile months, and the final 2 weeks of August tend to be on lower volumes, causing exaggerated moves in either direction, right? Think big vacation weeks across Europe and the U.S. We remain in the 41.15, 43.35 trading range. Watch the retailers to see what they report and what they say about the consumer and forward guidance. Remember, the Jackson Hole, Kansas City Fed boondoggle is only 9 days away. There is sure to be lots of speculation around what we're expected to hear. In any event, sit tight, because it's about to get even more exciting as we move through the next couple of weeks and months into September, October. Okay, so what are we having for dinner tonight? These are great. They are pork chops Benevento style. Now, Benevento is a place in Italy, right? So it's the style of pork chop that they make in Benevento, right? So Benevento's is a city in the region of Campania in the southeastern region of Italy. It's 50 kilometers northeast of Naples, and it sits atop a hill with a beautiful view of the valley below, and it's at the cross-section of the Salato and Calore Irpino rivers. It borders Molise and Puglia and is fairly mountainous, providing some unbelievable photo opportunities. It's also a region of the country where so many Italian Americans can trace their heritage. It is off of the beaten path, but it is well worth the visit. If you happen to just be hanging around in that area, it is beautiful. So put Benevento on your to-do list, right? Fennel is the key ingredient in this dish, and it grows like wildfire in Campania, and so you'll find it in many of their dishes, right? Because the cooking reflects the local vegetables and herbs, right? So for this, you're going to need 1-inch thick pork chops, salt and pepper, flour, olive oil, fennel seeds, maybe about a tablespoon. You need garlic, dry white wine, water, and beef bouillon cube, right? A cube of beef bouillon. If you don't have the cube, you can use the beef bouillon liquid. Preheat the oven to 300 degrees. Season the chops with salt and pepper, and then dredge the chops in the flour, right? You season them first, and then dredge in flour. Now, in a large saute pan, one that can go in the oven, so it's going to have a metal handle, heat up the olive oil. When it's nice and hot, you're going to add the chops, browning on both sides, right? So maybe it takes you a minute, 2 minutes per side. You just want to get them brown. Next, remove the pan from the heat and sprinkle the fennel seeds on one side of each chop, and then turn over and repeat. Now place the chops that are in the pan in the oven for 12 to 15 minutes, maybe 15, 18 minutes, depending on how many chops are in there and the thickness of them, whatever. When it's done, you're going to remove the pan from the oven and place the chops on a large serving platter. Cover with foil to keep them warm, because you're not done yet, right? You're not ready to serve them yet. Now, in the saute pan, put it back on the stove over medium heat. You're going to add 2 cloves of crushed garlic, and you're going to cook it until it's brown. Now you're going to add in a half a cup of the dry white wine and a half a cup of water, being sure to deglaze the pan and scrape up any of the brown bits on the bottom. Now crumble the bouillon cube into the pan and stir it until the sauce is reduced by about half. Remove the garlic and then spoon the sauce over the chops and serve immediately. These are really delicious. You're not going to go wrong. Make sure you have a big salad, a dressed salad the way you like it. You can also, make sure there's red onions. I love red onions, you know that. Cucumbers, tomatoes, dress it with salt and pepper, oregano, fresh lemon juice, toss it and serve. It is really delicious. So until tomorrow, take good care.